The results are in. Inflation came in cooler than expected, and the market was given the green light to rally. Santa came early this year with the Nasdaq officially exiting correction territory, and with rates falling across the curve, it really was a win for the bulls. But it wasn't just technology. Smalls and mid-caps were the leaders today in what marked a day of exceptional breadth. But it wasn't all good news. There were some very alarming figures in the CPI report that the market seemed to totally miss. So today we discuss the good and the worrisome. Join us as we talk about what this means for the market and where we go next. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Truthfully, it was a day with exceptional breadth. Tesla and Nvidia led the mega caps. Healthcare didn't catch the bid you think it would. Same with consumer defensives. Every other sector was green. Let's hop on the charts and have a look at the SPY. Now this is the SPY. We had a significant gap up which saw the market rally to the highs we last saw in September. However, bears did push us a bit lower towards the end of the day, but I would say that it was more profit taking from this incredible rally more than anything else. But we'll get back to the charts a little later. Let's dive a bit deeper into inflation. CPI data came in a lot cooler than expected. We were expecting a 3.3% print. We got 3.2%. Excluding volatile food and energy prices, core CPI 0.2% and 4%. They were expecting 0.3 and 4.1%, and this was the smallest increase since September 2021. So inflation as a whole is cooling. What really helped CPI decline was energy prices, which declined 2.5% for the month, which offset a 0.3% increase in the food index. And pretty much what this meant was that traders took this data report as no more rate hikes. Monetary policy is sufficiently tight enough. The tightening effects of monetary policy is seeing the flow-on effects into the market. Inflation is coming down and it's getting closer towards the Fed's targets. And along with this, treasuries fell across the curve. Have a look at this. Just 2 days ago, the 30-year was at 4.8% and the 10-year was at 4.7%. It is now at 4.617, 4.441 respectively. So rates are moving lower. The market really does like what it's seeing. The market's expectations for rate cuts have changed drastically. So just yesterday, we were pricing in the first rate cut in May. Now we're pricing in a 30% chance of a rate cut in March. And there is a 4.8% chance of a rate hike in December, as well as none in January. We pretty much moved from a rate cut in May to March, and we are expecting just over 4 rate cuts through to January 2025, and looking at an effective rate of about 4.2%. And this is why funds are adding to treasuries. We saw that FMS investors are the most overweight bonds since the global financial crisis. Investors are looking at rate cuts and saying treasuries are looking like a buy right now. It's down 50% from peak to trough in the last 3 years. We spoke about this in yesterday's video. And if we actually dive into the stats, we can definitely see here that once we found the trough, generally we can expect within 1 year returns anywhere from 6% all the way to 32% within 1 year. And it looks as if treasuries have bottomed, all things considered. Now, let me show you guys something very, very interesting. So this is the US stock market average returns 1928 to 2021 in different rate and inflation regimes. And you could see right here that when inflation is falling, the US stock market generally returns 14%. When rates are falling, it's generally 9.6%. And when rates are rising, it's 9.7%. So even if rates are rising or falling or inflation is falling, the stock market returns are generally good. And that's why we've seen quite a run in 2023. The only time the stock market doesn't perform is when inflation is rising. And that's probably why we saw a massive sell down in last year, 2022. So guys, always follow the stats. And I got some more stats for you. S&P 500 drawdowns and recovery times since 1946. So you can see a 10 to 20% decline has occurred 30 times with an average decline of 14%. The length of the decline was 4 months and time to recover was 4 months as well. And the average length between declines is about 2.5 years. So you get a 10 to 20% decline every 2.5 years. That's the volatility we have to contend with. Look at 20 to 40%. 9 declines since 1946, an average decline of 28%. It happens every 8.6 years. The peak to trough is only 8 months, but the recovery time is 14 months. And it goes to show that the recoveries generally last a lot longer than the actual declines. Bull markets are slow and steady. Bear markets are sort of like vicious and quick. And that's why it's always good to be bullish. For every 10% drawdown in the stock market, you should become ever so more bullish. And through all of this, everything we've seen today, guys, fear has left the market. We hit new neutral territory on the CNN Fear and Greed Index. Where do we go next? Probably greed. Last time we saw greed was about a year ago at the 62 level. I'm guessing it was about the December area. And while the move today was entirely led by the macro picture, there were clear telltale signs that were predicting this move higher. We saw the put-call ratio was above 1. And generally speaking, when the put-call ratio gets above this area right here, as it did at the start of this year and in 2020, we generally see sustained rallies all the way up to pretty much new all-time highs, and we saw that happen right here. But the put-call ratio did revert today, although still elevated. It did get below the 1 level, and we are at 0.88. That being said, there are still quite a lot of puts in the system. Now let's move on to some unusual options activity. What we saw today was a stark change in the puts and calls for the IWM. 318 million puts, 366 million calls. We normally get a billion in notional value on the put side, and we had some large volumes, 47 million in options contract volumes today compared to the average of 39 million, and it's 57% calls, 43% puts. Absolutely crazy. 5 days or fewer accounted for 50% of the market's call volume, and this is probably, and most of this is probably zero DTEs. They were the real big drivers of momentum today. But what is also helping inflation is oil. And if you told me a month ago that hedge funds would be short negative sentiment spread, and hedge funds are doing this as a part of the backwardation trade, if we actually go to crude futures, you could see that the spot price is paying about $78, whereas the forward month contract in January 2025 is paying $74. And what that pretty much means is that because the spot price is higher than the future price, it means that there's one of two issues occurring. There's way too much supply, or there's no demand. And we do know that it has to do with the demand issue because the Saudis have committed to 1 million barrels of oil cuts up until December. And this is going to continue to bring down inflation if we do see these prices materialize into 2024. But let's talk about market breadth. It was a stellar day across the market. The S&P 500 returned 1.9% today, but if you actually look at the mid-cap 400 and the small-cap 600, they returned 3.86 and 5.5%, and generally it was a bullish day across the board, and this is really what you want to see. Positive breadth is really, really good for the market. And because of the changing macro picture in the market with inflation, rate cuts, this has further solidified the fundamental picture. Now you can see that the forward month earnings per share for the S&P 500 is expected to hit $241. Now this is on the back of a 4.1% earnings growth in 2023. This is actually what we're currently at for this earnings season, and we're pricing in earnings growth all the way to 10.5% in Q2 2024. Now look at what the earnings growth was in September 2023. We've actually been revised down quite significantly, and these revisions downwards are actually in line with expectations. Negative consensus revisions to 2024 EPS align with the usual pattern. So what we're seeing in these revisions is nothing out of the ordinary. So the market is actually rallying on the macro outlook, the technical outlook, and the fundamental outlook. And this is why I think we go higher, because all of these three factors are lining up perfectly. And this is the average S&P 500 performance in Q4 over the last 2 decades, and you can actually see that the quarter to date the S&P 500 is actually underperforming, and that's because we had this massive drop in October, and this is why I expect a further run into the end of the year. Now let's look at data even further back than 2 decades, and this is the S&P 500 performance when we've been up more than 10% on the trading day 218, and the average return for the rest of the year is about 3.4%, the median return 3.7%, and this has occurred 90% of the time. So I also posted this on X earlier today, guys, right before the open, before the inflation data, and I said small caps and mid caps are about to catch an end of year bid, deeply undervalued relative to peers, time to play catch up, Russell 2000 to 212, and this was all based on oversold technicals, cheap fundamentals, and seasonality. Small caps are about to enter the best 3 to 4 months of the year, and we're kind of right about here at the moment, and we are expected a very big, 3 to 4% run since 1979 in small caps. And if you actually break that down into years, we probably are expecting a bigger run for the IWM, because this is where we are right now, and I can definitely see us rallying all the way up, even above this level, because the IWM is trading at about a 12 PE, probably 12.2 right now after today's very, very strong rally. So this is what we are. But let's have a look at Gamma. Yesterday that we had this massive strike, 44.50, 4450, which was going to be very hard to get over. But if we did get over it, we were going to run to 4500 very, very quickly. And that's exactly what we did. And we actually did peak over 4500 to 4513. Let's hop on the SPX chart. Our game plan, as always, was to buy this key support zone here. On my videos, the 25th of October and 26th of October, I said buy, buy, buy. I said it directly in my videos. We did that. We bought, and then we had a massive run up. And if you have a look at these green candles, these are the daily candles. These are extremely strong candles. This is bullish. This is bullish. This is bullish. And I've actually gone ahead and highlighted the two gamma zones right here, 4450 and 4500. And as you can see, we are getting very close to the late August, mid-September highs after the July sell-off we had. And it's going to be very, very constructive if bulls can break above this high and stay above the 4500 gamma zone level. That's going to be very, very constructive for bulls. One thing I also will add, it's going to be really interesting to see where this high gamma call resistance level moves up to. We saw it at 4400 just yesterday, then it moved up to 4450, and if it gets to this 4500 level, that's going to be very, very, very bullish. And this is the line we're looking at right here. This one right here. Let's move on to dark pools. There wasn't much in the way of dark pools. SPYs, QQQs, RSP all just saw no trades at the start of the day and big trades towards the end of the day. One thing I wanted to highlight was the 20-year treasury bond, the biggest trade since inception. And I showed you guys this trade last week. I told you guys explicitly that funds would not short treasuries at the levels where they are now, knowing that rate cuts are coming. And since then, TLT is up 4 or 5%. Very good trade here. It's very good to look at these dark pool levels and see what the big guys are doing, especially in the greater context of the macro picture and the fundamental picture. Looking at the day ahead tomorrow, we have PPI data, which is to be released, as well as retail sales. Thank you, everybody. Now, if you've watched up until this point, thank you so much. If you like this video, please subscribe, leave a like, a comment, share this video. You know I love you guys.